A small business making over $300,000 a year in profit can be bought for about the same price as a single rental duplex that clears maybe 5 grand a month. Same $1 million budget. One of these puts almost 7 times more cash in your pocket every year. So why do so many people default to real estate and never even consider buying a business? Today, we're putting $1 million into each path and following the real math: acquisition costs, financing, cash flow, taxes, and the risks nobody puts in the listing. By the end, you'll have a clear framework for which one actually fits your life. Here's the scenario, kept clean so the math is easy to follow. On side A, you take $1 million and use it to acquire an existing profitable small business, something like an HVAC company, a landscaping business, or a regional service company, boring, unsexy, and cash flowing. On side B, you take that same $1 million and buy investment real estate, using leverage the way most real estate investors actually do it. Same starting capital, same 10-year time horizon, two completely different paths to building wealth. Most finance videos get this wrong. They paint business buying as a fantasy and real estate as a risk-free machine. Neither is true. We're counting everything: financing, debt service, your actual time investment, taxes, and what happens when things go wrong. Let's start with the business. Most people don't realize you can buy an already profitable business roughly the same way you'd buy a house, often with way less cash down than you think. Small businesses typically sell for 2 to 4 times SDE, that's seller's discretionary earnings, which is basically the total cash benefit to an owner-operator. Let's say we find a solid, unglamorous service business priced at 3 times its SDE for $1 million. That means the business is generating roughly $333,000 a year in cash flow before any financing. That's the appeal in one sentence. Now here's the financing piece most people don't know exists. The SBA, the Small Business Administration, backs loans specifically for buying businesses like this, and typically you only need to put down 10% of the purchase price. That's just $100,000 down on a $1 million acquisition, with the bank financing the other $900,000. Assuming a 10% interest rate over 10 years, your annual loan payments are about $142,800. So what does that leave you with? Your $333,000 in cash flow minus the loan payments leaves you with about $190,500 a year in net cash flow, all on a $100,000 down payment. That's close to a 190% cash-on-cash return in year one alone. There is no legal stock, ETF, or rental property on earth that reliably produces that kind of return. But here's the huge catch. That cash flow isn't free money. Somebody has to run that business, answer the phones, manage the technicians, handle the customer who's furious their AC broke on the hottest day of the year. If you're the owner-operator, that $190,500 isn't passive income. It's a return on 50-plus hours a week of your labor plus your capital. And unlike a stock, this asset can go to zero. A key employee quits and takes clients with them, a new competitor undercuts your pricing, a recession hits.
This is a concentrated, high-risk, high-reward bet on the business and on you. Now let's look at the other side. Real estate feels safer, and there's real math behind that feeling. Let's put that same $1 million into rental property using standard 25% down financing for investors. That's a $250,000 down payment with a $750,000 mortgage. At a realistic 6% cap rate, meaning the property's net operating income is 6% of its value before financing, the property generates $60,000 a year. Now subtract the debt. At a 7% interest rate, a 30-year mortgage on $750,000 costs about $59,880 a year. That leaves you with basically zero cash flow. In today's market, this isn't a hypothetical, it's the reality for many new rental purchases. So why would anyone do this deal? For 3 big reasons stocks and businesses don't offer. First, mortgage paydown. Every month, your tenant is paying down your loan for you. Over 10 years, that $750,000 loan balance drops to roughly $630,000. That's $120,000 of equity you built without earning it through cash flow. Second, appreciation. At a conservative 4% annual appreciation, your $1 million property is worth about $1,480,000 in 10 years. That's an extra $480,000 in equity. Third, the depreciation tax shield. The IRS lets you write off about $36,000 a year in paper losses against your rental income. Add it all up, the minimal cash flow, the mortgage paydown, and the appreciation, and that $250,000 down payment could turn into roughly $600,000 of gain over 10 years. That's a strong return. And critically, it requires almost none of your time if you hire a property manager. But rental real estate is one of the most illiquid, paperwork-heavy assets you can own. Tenants cause damage, vacancies happen, surprise roof replacements happen, and leverage cuts both ways. If that property drops 20% in value, your equity takes a massive hit. So on raw cash flow, the business dominates, but on long-term equity growth with minimal time, the rental looks more attractive. This means we haven't found the real deciding factor yet. Here's the aha moment. We've been comparing $333,000 a year in business cash flow to $60,000 a year in rental income, as if they're the same kind of dollar. They are not. And once you understand this, the whole comparison changes. That $190,500 in annual business cash flow isn't pure investment income. It's largely a paycheck disguised as a return. You're not just buying an asset, you are buying yourself a job. Let's run the numbers on an hourly basis. Say you work 50 hours a week, 52 weeks a year. That's 2,600 hours.
Your $190,500 works out to about $73 an hour for your labor and your capital combined. That's a fantastic hourly rate, but it's not passive. It's not your money working for you, it's you working with your money at risk in the background. Compare that to the rental property, where your actual time commitment might be 2 to 5 hours a month if you're using a property manager. The rental's lower dollar return comes with a dramatically lower time cost. But here's the real kicker. The business isn't a true asset until it can run without you. The moment you want to sell, step back, or take a month-long vacation, does the cash flow stop? A business that requires the owner's daily presence often sells for a lower multiple. Buyers know they're not just buying cash flow, they're buying a job. A business you have to run isn't an asset. It's a job with a resale value. So the real comparison isn't business income versus rental income. It's a demanding second job that pays $73 an hour versus a mostly passive equity building machine that needs a few hours a month. Once you reframe it that way, the decision stops being about which number is bigger, and it starts being about what you actually want your life to look like. So which one wins? Here's a framework to help you decide. 3 questions in order. Question 1. Do you want to trade time for a higher return or money for a passive one? If you're willing to work 40+ hours a week inside the asset you own, the business wins on raw cash flow by a wide margin. If your goal is wealth that grows with minimal weekly involvement, the rental property with a manager wins on time efficiency. Question 2. Can this asset survive without you? Think of it this way. Could you disappear for 30 days and the income would keep flowing? If the answer for the business is no, you must budget real time and money, usually in the first 1 to 2 years, to hire and train a general manager. That single move is what turns a job into a true asset. It's what makes the business sellable later at a real multiple instead of just a liquidation. And question 3, what's your tolerance for concentrated risk? Both of these are concentrated bets, one property, one business, but their failure modes are different. A business can go to zero. A property, even in a sharp downturn, almost always retains some value because the land and the structure still exist. If a total loss scenario keeps you up at night, you should lean toward real estate. The bottom line is this: the business pays you for your time. The rental pays you for your patience. So here's my honest, no-hedging take. If you're early in your wealth-building journey, have real operational skill, and are willing to trade a few demanding years for outsized cash flow, buy the business, but budget for a manager from day 1, not year 3. If you already have strong income from a career and want a second engine that builds equity quietly in the background, buy the rental property and hire the property manager immediately. And if you want the best of both worlds, the move I see work most often,
Buy the business first. Use its powerful cash flow to fund rental property down payments over the following years. Let the active asset fund the passive one. That's not an "it depends" answer. That's a sequencing decision you can start planning today.